Hi everyone, welcome to our inventory chapter. Inventory is always a fun chapter. Students usually tend to like this one. It's got nice grids, it's kind of fun to work in. And I usually get asked, can we just have a test on inventory? Sadly, no. But at least you have something to look forward to in this chapter. Alright, so here's our review guide. Start off talking about inventory here. What I'd like to kind of point out to you is inventory is always one of two places. It's either sitting on your shelf, unsold, ready for sale, or you've sold it and it's in your cost of goods sold on your income statement. Okay, so if you think about it, you're purchasing inventory from somewhere and then you either have it or you've sold it. So it's either one of two places. It's either an asset on your balance sheet in the current asset section, or once you've sold it, those costs go over to the income statement and are listed in the cost of goods sold section. All right, so that's what you kind of have to think of with these things. They're either one of two places. It's either still an asset or you've sold it and it's an expense on your balance sheet as cost of goods sold. Okay, so here's my little, right? If it's unsold, it's still sitting there, and once it's sold, it goes in the cost of goods sold. If you remember, it's sales, right? Whatever the sales price is minus the cost of goods sold gives you gross profit. Okay, so I'm going to keep repeating that pretty much for quite a while. Just so you remember this little, at least this piece of the multi-step income statement we covered in the last chapter. All right, so the types of inventory valuation methods, kind of the four most popular ones, if you will. The first one is specific identification. And specific identification says you know the exact cost of each unit you purchase. Now that works best with unique high dollar inventory. So if it's something like jewelry, or cars, right? They're each unique. They have their own VIN number. You know exactly how much it cost you to acquire that inventory. So then when you turn around and sell it, you have that exact cost tied to it. It's almost like it has a price tag attached to it, right? You bought it. Let's say you bought this necklace for, $100. When you turn around and sell it, well, then I know that that is the specific necklace that I sold for $100, and that is going to be my cost of goods sold dollar amount. All right. It's not something you would use unless it's unique and high dollar, just because it's time consuming. All right, Fifo stands for first in, first out, and we'll talk about that in a minute in a lot of detail. And Lifo stands for last in, first out. Weighted average is somewhere in between. All right, I think he's done. Sorry about that. Weighted average tends to fall somewhere in between Fifo and Lifo. All right. And it's kind of a blending of costs. As you go along, you recalculate the average. Every time you purchase new inventory, you update the average cost of your whole inventory stock. All right, and we're going to go through some examples on that. All right, so here's my little tennis ball example. I'm kind of torn on whether or not I show this to you again. I have a video that does this, but I will give you a quick version of this. Let's say I bought 3 tennis balls, a $1 tennis ball, a $5 tennis ball, and a $10 tennis ball. Okay, 1, 5, and 10. All right, so I've got these 3 tennis balls, and I bought this one, the $1 tennis ball in January, $5 tennis ball in June, $10 tennis ball in August. All right, so here we go. And I'm selling one tennis ball for $20. The question is which one did I sell? Well, it depends on what inventory system you're using. All right, so let's pull up the balance sheet and the income statement here. All right, we're going to be looking at Fifo first. Oops, I clicked on something I didn't mean to. And Lifo. All right, we're going to start off with Fifo. Now let's say we're selling the $20. We're selling the tennis ball for $20. Doesn't matter which one we sell. They're interchangeable. But the question is what is the cost of goods sold? Which one did I sell? Did I sell the $1, the $5 tennis dollar? Once they're all in the bin, they all look exactly the same, right? But we're tracking inventory costs here. So if we think about it, I bought a $1 tennis ball, $5 tennis ball, and $10 tennis ball, right? That's what I have in this tube here. Well, if we're looking at Fifo, Fifo stands for first in, first out. So the first one that I purchased is the first one I'm selling. So the first one I purchased was the $1 tennis ball. That's going to be the one I'm saying I sold as my cost of goods sold. So there's my $1 cost of goods sold, making my profit $19. And what do I have left in ending inventory? Well, I have the $5 and $10 tennis balls still. I still have the most recent ones. Oops. So I have $15 in my ending inventory. Okay, so now let's take a second. Let's look at Lifo. Same idea. I bought a $1, $5, $10 tennis ball. and I'm still selling it for $20. The question is which one I sell. Well, Lifo stands for last in, first out. Okay, the last one I purchased is the first one I'm selling. So I'm selling the $10 tennis ball because that was my most recent purchase. Making my profit $10. Okay, vastly different, 19 to 10. And I'm really just selling any old tennis ball that I have in my bin. It's just a matter of which costs am I reporting on my balance sheet and income statement that I'm selling. All right, so what do I have left in my ending inventory after I sell the $10 tennis ball? I have the $5 and $1 tennis ball, so my ending inventory will show $6. All right, so why would you choose one over the other? Well, they each have their positives and their negatives. Under a Fifo system, you're selling the most recent, you're selling the oldest inventory. So if you think about it, Fifo is kind of like when you sell milk, right? If you sell milk, you're always selling the oldest milk first, right? That's the one going first out the door because it's the oldest milk, right? Or bread, something like fungible like that. Lifo doesn't really have a good comparison. The only thing I could think of, honestly, was like a rock quarry, right? If you have a giant rock quarry and a huge pile of stone, if you ever had to go buy stone for some reason, what they do is they take right off the top the most recent stone. So it's kind of like Lifo. All right, but let's talk positives and negatives. All right, if it's Fifo, you're going to show greater profit, right? As long as it's a period of rising prices. Everything I'm saying here is as if it's a period of rising prices, meaning that the costs are going up over time. If they were going down, pretty much everything I'm saying right now would be reversed. So we're just going to, period of rising prices is more normal. Prices tend to go up more than they go down. So we're going to stick with that. All right. So you show greater profit under a Fifo system because you're always selling the lowest cost inventory, which means your cost of goods sold is always going to be low. Unfortunately, what goes along with that is you're going to wind up paying higher taxes too because you have showing more of a profit. And inventory is more fairly stated. If you think about it here, I've got 2 tennis balls and the price is $15 in my inventory, and that's okay. I mean, tennis balls are about $10 each now, but 15 isn't so far off value-wise. And you'll see what I mean when I get to Lifo. All right, so if we did Lifo, we show less profit, paying less taxes, but the problem is, one of the problems is inventory is understated. All right, if you think about it, I've got 2 tennis balls right now, right? And tennis balls right now are selling for $10 each, but yet I have 2 tennis balls that are only showing at $6. So under a Lifo system, the oldest inventory costs are what you're holding on to, meaning that over time your inventory is going to be undervalued or understated. It's just the way Lifo works. Now, why would you choose one over the other? Well, it depends on what's important to you and your company. If you are looking to show like big profits and you're looking to show the world, look how great we are, invest with us or something like that, you'd probably choose a Fifo system because it shows the most profit and most gains. Well, most profit. Lifo system, maybe you should, but maybe that's not important to you. Maybe you've been around a really long time and you're not even caring about showing huge profits. Instead, what's important to you is retaining your income, right? Retaining the funds. You get to hold on to a heck of a lot more money under a Lifo system because you're not paying taxes on the increases and so on. So if that's the case, you're a long established company, let's say, and you don't really care about showing these huge profits, a Lifo system is a better tax saving system. One of the things with IFRS, right, remember International Financial Reporting Standards, is that they think Lifo is ridiculous, and Lifo kind of is ridiculous in the sense that you're not always selling the most recent inventory. Like, it's purely a tax savings thing. So one of the things we would have had to get rid of if we converge with the international reporting standards is Lifo would have had to go away. And can you imagine some companies would have been pretty upset about that because they would have had to sell off all their $1 tennis balls and would have had to show really big profits. I mean, there were bunches of things that kept us from merging, but this, I'm sure, was one of them. Now, one thing that's all right, ready for this? This might blow your mind a little bit. Just because your inventory, maybe you have like milk, right, your groceries, just because your inventory flows technically in a Fifo system, right, the oldest milk goes out first, a grocery store can still turn around and decide they're going to use a Lifo system. Your inventory system that you choose does not have to match the way your products flow. I mean, ideally that's what it's meant to do, but You can choose something else. So if you, let me say it one more time. So if you're ShopRite and your inventory clearly flows out in a FIFO system, the oldest stuff gets sold first, you can still choose for your accounting purposes to use a Lifo system or any other system for that matter. Okay? Your product flow does not have to match which inventory method you choose. Okay. All right, so I'm going to pause this and we'll move on to the next one. I'll give you guys an example.